problems that are on the horizon aren't new. They're not different than what we knew a week or two ago. Is this just everybody's back to work, back to school, kind of back in the fall, and this is when we start kind of harping on those same problems and focusing a little deeper?
So I do think we have been focusing on the risk of a global recession for a few months now. And we have seen that reflected specifically in currency markets, with the dollar continuing to rally up near 20-year highs versus several currencies. That's really where you see this flight to quality magnified. I think over the weekend, the global growth angst built up a little bit further. Europe, with regards to the energy crisis, with Russia closing the flow of natural gas through the Nord Stream 1 pipeline indefinitely, and questions building about winter in Europe and how severe a potential recession there could be, as well as some angst building in China with the extension of lockdowns in several important cities, and just the true toll that that has been taking on confidence in the country, limiting any pace of reacceleration. So we continue to see a lot of this angst building in currency markets. And this certainly doesn't help the outlook when it comes to these local economies. It fuels inflation in Europe, for example, leading partly to the ECB hiking rates later this morning, we think by 75 basis points. And it certainly doesn't help the growth picture in the U.S. either, in terms of the economic picture, with trade weighing on growth, or the earnings picture with a stronger dollar, we think, weighing on profits of large multinationals, which has yet to be factored in.
Gabriela, add all that up. You think stock market's going to head lower from here or stabilize?
We still think this is a very difficult moment for the stock market as we continue to grapple with these cyclical issues around the probability of a global recession, a U.S. recession, which is very dependent on what happens overseas, as well as what happens here in the U.S. with Fed policy. And the stock market continues to also grapple with some longer-term questions coming out of the pandemic and into the next cycle. What is the real rate, and what does that mean for multiples? Have we corrected them enough? And what does it mean for demand for certain sectors that saw such a huge boom during the pandemic? What's a more normalized earnings stream for those companies? So we're still grappling with some big cyclical and structural questions. And to us, that means that the stock market is still due to see quite a lot of volatility here in the fall before eventually resuming a new bull market later on. So for us, it's still a bit too early to start taking on risk. We see a lot of clients wanting to do so because we have already had a tough year and valuations have corrected. But on a broad basis, we would still be underweight stocks and high yield credit.
When you say you see trouble this fall before a bull market continues down the road, you mean later this year, or you mean next year and beyond?
I mean over the difficulties, or shall we say the question marks that we need to resolve. I think we'll largely get a lot of visibility that in this fall and into the winter. We'll get more visibility as to where interest rates end up, not just at the end of this year, but into next year as well, which is the big question for these two structural and cyclical questions in the U.S. And we'll also get more visibility around how Europe is able to navigate the winter and how China plans to navigate COVID after their important National People's Congress on October 16th. So I do think it's a choppier fall, but setting us up for a much, much better 2023 when it comes to stock markets. I just think it's a bit too early to dial up the risk exposure right now. It's still a time to be thinking more carefully about how we take risk.